So now we're going to take a look at the objective constraints and qualitative characteristics of financial information. So as we've been discussing, we have both the US generally accepted accounting principles and the IFRS. They both conform to an underlying conceptual framework that forms the basis to determine how business transactions should be measured and reported. The conceptual framework allows for two different types of accounting: rules-based accounting, and that is where the accounting standards are stated as a list of specific detailed rules that must be followed when preparing financial information. To apply these rules, accountants have little room to make their own judgments, and the US generally accepted accounting principles are primarily rules-based. Principles-based accounting. The accounting standards are designed as guidelines, and accountants are allowed to flexibly apply those standards when preparing financial information. And the International Financial Reporting Standards, the IFRS, those are more principles-based. So the framework is shown on the following. So we see here that the objective of the financial statements is to provide useful financial information to a wide range of different users. And again, the characteristics of financial information, we want to make sure that the information is going to be relevant, that it's going to be reliable, that it's going to be understandable, and also that the information is comparable. And some of the basic assumptions and principles are that we're talking about a business entity, that the business is a going concern, meaning that it's going to want to continue to progress, and that we're speaking of with a particular monetary unit and based upon a particular time period. And then and again, the principles are that we are measuring and then looking at our revenue recognition, our expense recognition, and proper disclosure. And that our components of the financial statements, as we said, are going to be our assets, our liabilities, our equity, and in our revenues and our expenses. And in our constraints, we have the cost constraint, the materiality constraint, conservatism, and consistency. And we're going to go into more detail about these as we progress. So constraints of financial information. We have the cost constraint, which is to ensure that the value of reported financial information outweighs the cost incurred to report it, even if the information would improve the accuracy and completeness of the financial statement. So again, there's a cost to preparing some of this information, and so looking at that and weighing that. Materiality is considering the significance of information to the user. A piece of information would be considered material if it could influence or change a user's decision. So making sure that they have all of the information that is material to be able to make certain decisions. Conservatism states that when an accountant has several options in applying an accounting standard, the least favorable option is what should be selected. So being, conservative in our assessment. And inconsistency prevents businesses from changing accounting methods for the sole purpose of manipulating figures on the financial statement. So that's one thing that we don't want to do. We don't want to manipulate information just to be able to make things seem better. So we want to make sure things are being consistent and we're doing things the way that we've always done them. Now, some qualitative characteristics of financial information are relevance. All of the information that is going to be useful for decision-making is going to be present within the financial statements. Information is relevant if it helps users to predict future performance or to be able to confirm previous predictions. This also deals with timeliness, which means that there's no delay in reporting crucial information. So we have to make sure the information is being reported in a timely manner. Now, reliability is the information has to be free from significant error. That includes verifiability, which is the ability to see how a company arrives at a certain result. It depends on faithful representation, presenting the financial impact of a transaction rather than a legal form. And it has to be based on neutrality, meaning that the information is free from bias towards the interest of the certain users. Also, we have understandability, which is that the information has to be reasonably understood by users. And then comparability is that financial statements are prepared in a similar way year after year. We're able to compare each year and the results. So trade-offs of qualitative characteristics. If all characteristics cannot be fully represented, there may be a trade-off or exchange of part of one characteristic for another. The trade-off, so this, for example, the trade-off between relevance and reliability. Timely information may be less accurate because there isn't enough time for the information to be properly reviewed. So we want to make sure of that and be aware of that. Accurate information may be less relevant because it takes longer to prepare and may be out of date. So again, working with the trade-off that it might exist in that. So which qualitative characteristic does financial information lack if it contains a number of significant errors? Is it relevance? Is it reliability? Is it understandability? Or is it decomparability? And it would be reliability. So the information wouldn't be reliable if it had a lot of errors.